Hey guys, Max here, and yesterday was the last day of the week, it was the last day of the month, and so it was also the last day of the first 4 months of 2022, and with that, there was quite a lot to talk about. Firstly, about what actually happened in the markets yesterday, and then briefly just a little bit about the last week, the last month, and this year so far, about the broader picture of the market today, because as of right now, the last month really was awful, and the start of 2022 has been totally awful as well. Most people just aren't recognizing how bad it really is because they have incorrect assumptions about how crashes of the past have happened. Yesterday then, how did it go? Well, absolutely awfully, to be honest. The day before yesterday obviously was really super bullish. It was green all over, stocks were up everywhere. Investors just ignored the bad GDP figures that the US saw and the tough earnings for some important companies, and they rallied. But yesterday, all of those gains disappeared because the red of Friday was worse than the green of Thursday. Now, as you can see, it's just red everywhere. Hardly any of the companies actually rose in value at all. Every single sector fell. It was a complete bloodbath. Now, the worst performer was, of course, Amazon, down 14% in a single day. That's over $200 billion of value lost in a single day, and Jeff Bezos lost about $20 billion of his wealth in a single day. We will talk a little bit more about Amazon later on though, because of course they had their earnings report. Now, Tesla stopped its rout and held firm at just under $900 a share, probably because Elon stopped selling shares himself. He stopped putting that downwards pressure on the stock, and he also came out and told us that he was going to stop selling shares in the future too, so there was just a little bit of reassurance. How did the actual indices look then? Well, really poorly. The S&P was down by 3.6%. Very bad. The Nasdaq was even worse because tech did even worse, and it was down 4.2%. The Russell 2000, which is made up of small cap stocks that make up the American economy as a whole, they are mostly domestic companies and usually not international, well, it was down by 2.8%. The rest of the world actually did okay. It wasn't anything special, but it wasn't awful either. The FTSE 100 and the Stoxx 600 were both up by about 0.5%. Tech on the whole then did worse, along with just most American stocks. Why did they do so badly though? Well, it's just the general idea that tech companies and their profits are not growing as fast as people thought they would, which isn't ideal, especially for these high valuation companies. That is just about enough for a bloodbath. The Federal Reserve tightening is still terrifying too. A 75 basis point rate hike is looking very possible for June, which is scary. COVID in China and the war in Ukraine actually seem to not have much effect on American markets right now. There are enough problems at home, it seems, so investors don't even need to worry about things overseas, even though they should. Now, bond prices continued their decline. US 10-year yields rose by 8 basis points to 2.91%. Again, getting very close to 3% yields, far too high for tech companies to take out loads of debt to finance their maddening growth. The US dollar actually weakened slightly, not by an awful lot though. The euro is still sitting at about $1.05 and the pound is still at about $1.25. Oil prices stayed high once more. WTI crude is above $104 a barrel at the time of me making this video. Brent crude oil is at $106 a barrel, so there's no downwards pressure there yet. And gold prices are still hovering around that $1,900 an ounce mark. They are just $2 below that mark right now, which is sort of surprising. Things are looking awful for the markets, but we need to remember that gold is always a good inflation hedge, but it isn't always a good market hedge. Now finally, crypto, what happened there? Well, there were just declines across the board, but not actually awful ones. They actually did a bit better than the Nasdaq, funnily enough. Bitcoin is sitting above $38,000 and Ethereum above $2,800. They were both down 1% or so for the day. Altcoins were down around 2 to 5%, something in that region. Nothing really special going on, just poor sentiment, no specific news causing that decline. So it was a bad day, but how was the week? Well, actually okay. Still down, but not by any awful amount, thanks to Thursday, where stocks hiked up for a moment. As you can see, the big losers were Tesla and Amazon, and the big winners were Facebook, surprisingly enough. That stuff is mostly based on earnings. The S&P 500, though, was down about 3% on the week, and the Nasdaq down just over 3%. The month then, was it a similar situation? Well, no, the month was absolutely atrocious. It was the worst single month for the Nasdaq since 2008. 13% in value lost in a single month. Total capitulation of tech stocks. The S&P 500, well, it was down 9%. Every sector was down except for consumer defensives really. Everything else fell in value. Some of the largest companies fell by huge amounts as well. Nvidia falling 33% in a month. Amazon down 25%. Tesla down 20%. These are absolutely huge moves. What about the markets for the year to date then for the first 4 months of 2022? Well, again, absolutely awful. This has now been the worst start to a year since 1939, over 80 years ago when World War II literally broke out. The only sector up by any meaningful amount is energy for obvious reasons. Super high gas and oil prices means that there's more profits for these gas and oil companies, so their share prices are rising. Everything else though is down lows. Tech is of course performing the worst. The S&P 500 is down by 14%. The Nasdaq is down by 22%. The Russell 2000, the index that best encapsulates the US economy in my opinion, it's down 18%. The rest of the world then, how's Europe doing for instance? Well, the Stoxx 600 is down 8%. The FTSE 100 is actually up by about 0.5%, which may seem surprising, but it's got a very heavy weighting to the energy sector with companies like BP and Shell, so it actually makes a little bit of sense. What's happening in China? Well, the Shanghai Composite Index is down by 16%. What about Japan and the Nikkei? Well, that's down at 8%. This really is an awful year for stocks so far, and as I said, it's the worst in over 80 years, but people are still claiming it's not really that bad. Taking a look at the Nasdaq in particular, especially at some of those higher growth companies, it's in a really poor situation. 45% of Nasdaq listed companies are down more than 50%. 22% of the companies are down more than 3/4, and 5% of the companies have lost 9/10 of their value so far. The only time the Nasdaq has ever been this poor before in history is during the dot-com crash and the housing market crash. Now, why then is there so much denial about this not being a crash? Well, because people's memory isn't as great as they think it is, and we as people just tend to place more importance on recent events. The word crash, collapse, and bubble, they all make us think of instant declines where stock markets tank by 90% in a day, and then they start going back up again, but crashes really don't work like that. I'm still getting so many people ask me if this even is a crash because it's going down slowly, but they don't question the idea that 2008 was a crash when it took 2 years for the S&P 500 to lose about 50% of its value. That was a crash and no one denies that, but it was slow and it took a long time, and we are on track for that same sort of crash this time. The same can be said for the dot-com bubble and that subsequent crash. Because we call it a bubble, people think that it grows and grows and grows until it pops in an instant, but it doesn't. During the dot-com bubble, it took the S&P 500 2.5 years to drop by about 50% in value. The problem is that people look at the COVID crash that did happen really quickly over the course of about a month, and they think that it was normal, but it just wasn't. It didn't crash because businesses couldn't make money because their earnings fell. It didn't crash because people lost income or they lost their jobs and couldn't pay their mortgages. It crashed because the government turned on a button that made it illegal to do business. It was utterly unique. We've never seen a crash like it before. Hopefully we'll never see one like it again. But a crash like that happens that quickly can only happen because of a government policy. This crash this time round for 2022, there will be bull traps like that 3-week bull run we had just over a month ago. There will be ups and downs, there will be periods of sideways trading, but it will trend downwards probably for about the next year minimum, yes, an entire year, and probably it will even go longer than that. Try to remember that this is a slow process and it will take time. Now with that little detour done, onto Amazon and their earnings, because I know some people are wondering why they fell 14% and lost $200 billion in a single day. Well, their earnings were actually a mixed bag. There were some good bits and some bad bits. Amazon Web Services, AWS, which is basically cloud computing type stuff, is really strong. It beat its expectations with $18.4 billion in revenue last quarter, which is 37% year-over-year growth. That is absolutely brilliant. This part of the business basically holds the rest of Amazon above the water because it is so profitable while the rest isn't. The problem is that the rest of the business did quite poorly. Earnings per share was a loss of $7.56 compared to an expected profit of $8.55, so a huge miss. That was actually the first unprofitable quarter for Amazon in 4 years as well. In fairness now, it's really because of a paper loss of about $7 billion because of Rivian, the electric truck maker. It's still not good though. The other bad news that was actually really bad was that Amazon cut their forecast for future revenue down by about 10%, meaning that they are only expecting growth of 3 to 7% over the next year. That is absolutely not what investors wanted to hear, so people sold their shares by quite a lot. Of course, that's why the share price fell by 14%. That was a huge hit, and it was actually the second largest single-day loss for a company in world history, only beaten by Facebook's big drop about 2 months ago. Markets really are just in a tough spot right now. There is nowhere to go. There is pressure from all sides. GDP figures for the US fell, but most people just sort of ignored it because the idea was that consumer demand was strong. But the US is a global economy, more so than any other country as well. In Europe, a recession is literally upon us. The data is only just coming out, but it is practically here, mainly because of this energy price spike. Consumer demand in France, for example, actually fell last quarter. So people are spending less money. That means less profit for businesses. People will get laid off and everything will suffer. And this will impact America's economy too. This is also the same measure that everyone in the US was pointing to, saying that actually that's the important one. But when it comes to France, maybe it isn't important. That will be the argument this time. When you combine that with the fact that consumer sentiment is just ridiculously low right now, and the fact that wages are rising at far lower rates than inflation, and when you consider that inflation is actually far worse than the Federal Reserve and the Bureau of Labor Statistics would have you believe, then things just aren't very good. Now, people or investors like Cathie Wood, who are incapable of adapting to changing circumstances, are pretty much doomed to fail here. Cathie Wood came out the other day and doubled down on Teladoc, claiming that it is the next Amazon of the world, right as Amazon saw its growth collapse and its share price drop by 14% in a single day. The reality is that it's very difficult to actually change your opinions and your views. Cathie had years of success based on sniffing out innovation and hyper-growth companies, and she should be paying attention to inflation, to the Federal Reserve's rhetoric, to consumer demand, and changing her strategy based on those facts, but she's refusing to. Her results are now so bad this year that ARK-K, her flagship fund, is down 20% since before the COVID crash. Her insanely successful year following the COVID crash, where she basically became famous and became one of the world's most famous, most successful fund managers, now amounts to absolutely nothing because over 2 years she lost all of those gains and is now down at 20%. The simple fact is that times have changed. Growth is not the aim anymore. It's stable businesses that can survive recessions, that have strong moats and can perform in inflation, and those companies are not characterized by Teladoc. Now, if you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that can help you protect your portfolio against inflation through fractional shares of art from world famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets on the brink. It's completely free to sign up, so make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get over 7% interest on stablecoins to protect your hard-earned cash from being eaten away by inflation. Thank you all for watching. Stay stoic. Until next time.